Hi everyone, I'm Lexi. I'm the TA for the semester. I'm going to go over two practice exams for you for exam one. It's going to be one from 2019, which is a different book, just so you guys are aware. So some of the things are going to be a little bit different. And then 2020, which is going to be more similar to the exam, but I'll go over both just for extra practice. If you would like these emailed to you with the notes on it, I can do that as well. If not, I'm pretty sure both of the professors at least sent you one of the exams. And also, I will be hosting an in-person review session on Monday, the 27th, and it's going to be in Bisgrove 127 at 5 p.m. It'll probably be from like 5 to 6, depending on who shows up. Basically, if the people that showed up didn't watch this video ahead of time, we'll go over the practice exams. And if everyone did watch it, then we'll go over basically any questions that anybody has. So I'll get started and share my screen so we can go over them. All right, so first, the key characteristic of an asset that it represents a probable future economic benefit. That's going to be true. So that's basically just the definition. And it's already highlighted here for you. A liability is future sacrifices of economic benefits that it's already obligated to make. So if it was a liability, that's the definition of that one. So it's a future sacrifice, where this is a future benefit, where a liability, I'll write this down, is sacrifice. Sorry, it's a mess, but regardless of the business activity recorded, the left side of the account is a debit side and the right side is the credit side. That's true. That's also just standard definition like we've done in the journal entries and like you've done in homework, class, etc. So a trial balance is a list of the title and numerical code of all the accounts in the general ledger. That's false. So it's actually, I'll write the definition here. I'll just type it out and then it's because it's a long definition. A trial balance is a bookkeeping worksheet which debit and credit columns are equal. So which of the following statements about double entry bookkeeping is true? The total amount debited must be equal to the total amount credited. So they always have to equal you. Your debits always have to equal your credits no matter what. There's no way around that. You always have to equal. So which of the following forms of a business organizations exist as a legal entity for tax purposes? So this is going to be a corporation and it's basically recognized as law, basically in law. So that's just going to be the standard definition. Financing activities are generally categorized as debt or equity financing. So basically, when you're doing your statement of cash flows, that's when you use the financing activities. Anything that deals with debt or equity would be in the financing. Anything else would be in, it depends on if it's normal course of business, that would be cash. And then if it's anything that deals with investing, would be in investing. So which of the following is not part of the standard heading of a financial statement? So the company's industry is not a part of it. So like we've done these in homeworks, you always have to put the company's name, the title, like if it's a balance sheet, income statement, etc. And then you always put like either at like September 30th or from the month of endings, etc. And then let's see what's next. So on January 1st, 2019, Little Robot invested $300,000 of common stock to start Bot Corporation. During the year, Bot Corporation had total revenues of $60,000 and total expenses of $16,000. So cash dividends totaled $12,000. So what is the balance in retained earnings at the end of the year? So retained earnings is essentially very similar, or if not like the same as net income. So in order to do this, you're doing revenues minus expenses. So when you're finding retained earnings, you're essentially finding your net income. So the 300 is, so we don't need to use this 300 for common stock, so we can just ignore that, but we have total revenues of 60, and then we subtract out the expenses of 16. And since the cash dividends were paid, we also have to subtract those out too, and then that's going to give you 32. 12, the cash T account of Firefly has a beginning balance of $156,000. During the year, $732,000 was debited and $723,000 was credited. What is the ending balance of cash? So if we do a T account, we start with 156 And then since 732 was debited, put that over here. 723 was credited, put that over here. Basically add these up, subtract there, and then the total would be 165. Because it's a positive number, it's going to be on the left side. So that's going to be that amount right there. So the company received 11,000 cash in exchange for 200 shares of the company's common stock. What would the effect of this transaction on the current year's accounting equation be? So since they received cash, right, since we received cash, it's going to increase your assets, and this cash is an asset account. And since there's basically it would either be assets or liability. So since we already dealt with assets, it would have no effect on liabilities. And since we increased our assets, it's going to also increase the stockholders' equity because you're getting 200 shares as well. Which of the following errors, each considered individually, would cause the trial balance totals to be unequal? So a payment of $422 to a creditor was posted as a debit, on that of 4,222 to accounts payable and a credit of cash. So there's this error right here. There's an extra 2 in the account. So that's what makes this one correct, because obviously these two equal, but with that amount being different, that's not going to equal. Assume December 31st is a Monday. Circle Woods Company's wages are paid every Friday, and the weekly payroll for 5 days amount to $36,000. To record the correct amount for December, Circle would make the following entry. So for this, it says for 5 days, and for 36,000 is the total. So we have to figure out what it's going to be each day. So we're going to take 36,000 and then divide it by 5, and that's going to give you 7,200. And it's going to be wages expense and wages payable, because we're looking for the expense and we're paying them out. So that's why the paying is going to be the credit and the expense is going to be the debit. In preparing the adjustive entries at the end of the year, Pine Grove Company neglected to adjust the prepaid insurance account for the amount insurance expired. So what is going to be this error? So prepaid insurance is an asset account, so it's going to end up overstating the net income, since the assets are included in net income, and then it's going to also overstate retained earnings and assets. So that's why it's going to be D. And which of the following is a permanent account? So anything that's a permanent account goes in the balance sheet. So this amount, accounts receivable, it's going to be a permanent account. Under the accrual basis of accounting, basically, this is just a standard definition. Events that change a company's financial statements are recognized in the period they occur, rather than the period when cash is paid or received. If this question asked for a cash basis accounting, definition would be revenue when cash is received and expensed when cash is paid. Question 20, earlier in the accounting period, Ed Shear, a client, paid $9,000 for services in advance for receiving them. Cash was debited and unearned service fees was credited for $9,000. At the end of the accounting period, 2/3 of the services has not been paid. So for this one, basically, we take 9,000, multiply it by 2/3. You get 6,000, and then you subtract out the 9,000 minus the amount that's already paid. So you would get 3,000. And since it's unearned, since we use unearned services were credited, so we have to debit them in this to reverse it out. And then we earned the service fees. That's going to go there. The beginning balance of Polypart and supplies were 2,600. At the end of the period, the company only determined 1,600 were still on hand. So we're just going to subtract 2,600 minus 1,600, and that's going to give us 1,000. And the adjusting journal entry is essentially just flipping it. So that's why we're going to debit the expense and credit the supplies. Which of the following is not considered a current asset? This is equipment, because a current equipment is essentially long-term, because if you have a table is not going to just disintegrate in a year under like a normal course of business. Like accounts receivable, it's always quick. It's going to be received quick. Prepaid rent, you have to pay the rent within a year. You can't like tell a landlord, sorry, I'm going to pay you in a few years. Same with supplies. Supplies you are going to be a current asset because you receive them, and it's supplies or something that like you have a pen, like you're going to receive the pen right away and you would just pay for the pen right away. The primary component of stockholders equity section is going to be common stock and retained earnings. We've done those a lot in homework questions. Those are the amounts that are always included in there. 24, this is the data from the financial statements of these two companies presented below. To the nearest 100, what is the debt total assets ratio? So for this ratio, we're going to take this total liabilities amount and divide it by the total assets. And since it says for 2019, we use those amounts. So the 70 minus the 100, the full at 7914 divided by 103.72, and that's going to give you this amount. So use these full numbers. I just didn't type them out all the way, but definitely use those two accounts. The current ratio, this is just a definition, current assets divided by current liabilities. Best Ball Bearings is a return on sales of 24.60, and Amazing Automotive has 27.45, which the following is true. Amazing Automotive is more efficient at generating profits from its revenue because they have a higher return on sale. Which of the following is not a category for classifying cash flows in the statement of cash flows? This is going to be non-operating, because when we looked at the statement of cash flows, you need operating, financing, and investing. You don't need non-operating in the statement. Rock Springs Company has a beginning retained earnings account of $60,000, earns a net income of $150,000, and has an ending of $736,000. So what amount is paid in dividends? So we start with 600, add 150, subtract out 736, and then the ending amount is 14. All right, so now we are going to move to short answers. So Helen's designs the following accounts in its general ledger: cash, accounts receivable, supplies of office equipment, accounts payable, etc. So we're going to prepare the following journal entries. So for the first one, shareholders invested $330,000 in cash in exchange for common stock. So let me just we'll do them here. So this first journal entry is going to be, you put May 1st. And since you invested it in exchange for cash is going to be debited because that's what we're receiving. And then common stock is going to be going out because so the shareholders invested, gave us cash, and then the common stock is coming out. So May 4th, purchased office equipment for $27,000, paying $9,000 in cash for the balance due on account. So we're going to debit equipment because we purchased it, so we're receiving the equipment of the full amount of $27,000. Oops, sorry, I forgot to put these amounts in here. 330, just the same amounts. 30. So equipment, $27,000, and then since we paid cash is going to go out, and we only paid $9,000, so we can only include the $9,000 there. And then where it says the balance is due on account for 60 days, whenever it says paid on account, it's going to be accounts payable, and then it's just going to be the difference because we paid the rest on account, so that's going to be $18,000. May 5th, purchase supplies on account for $6,900. So we're receiving the supplies, so we're going to debit supplies for $6,900. And purchased on account, same thing with the other question, we're going to credit accounts payable for $6,900. May 12th, billed clients for services of $17,400. So when you bill clients, you're going to debit accounts receivable. That's going to be a key word for that account, is going to be billed clients. So it's going to be $17,400, or just bill in general. And then since we're using for services, the credit is going to be service revenue. May 18th. Put space here so it looks better. Collected 11,400 on account from clients. So we just said on account from clients, and when you use collected, it's also going to be another keyword for accounts receivable. But first, since we received that amount, we're going to debit cash for 11,400, and then we're going to credit accounts receivable for 11,400. And then May 19th, paid 4,500 on account to suppliers. So since we paid them out on the account, we're going to debit accounts payable. And since we paid them in cash, basically, so since we received the accounts payable is going to be sitting there, but since we paid the suppliers, you pay suppliers in cash when you debit accounts payable, because it doesn't say that you paid it in anything else. So we would assume that it'd be cash for 4,500. And then May 26th, paid 27,000 cash dividends. So since we're receiving the dividends, we're going to debit dividends. And since we paid in cash, we're going to credit cash. All right, last one, May 31st, paid May rent of 5,900. So since you paid the rent, you pay rent in cash, and it's going to be an expense on our account. So we're going to debit rent expense for 15,900 and then credit cash. All right, perfect. And these are just the answers right here that we just did. Problem 2, financial statements and closing entries based on the above trial balance, prepared the income statement, statement of retained earnings, and balance sheet, and then also prepare the closing. So for this one, first, so these are the answers already here, so I'll just explain these so it's not all retyping and wasting your guys' time. So for the income statement starting, we always do revenues minus expenses. So for this to start, we find our revenue on our trial balance, which is right here. It says service revenue. And let's see. Let me just highlight this just so it looks better. Okay. Sorry, that's not straight whatsoever. But service revenue, there's no other revenues. So that's why it's going to be right here. And that's going to be the only revenue that we use. And then we're going to subtract out all of our expenses. We look at our expenses and we have these 3 expenses right here. So those are the amounts that we're going to subtract out from our revenues. So that's why we use wages, rent, depreciation. This amount right here is just the total sum of these 3. And then we just take the service revenue minus the total expense, and that will give you net income. Now for our statement of retained earnings, we have to first, we don't have to look at this yet, but then we go down the beginning retained earnings. Let's see, we'll go back. We're going to use this amount right here. So if it doesn't always give you a beginning balance. And so if you're doing a statement of retained earnings and it doesn't give you the amount in the trial balance, you would just start with adding net income in. So you wouldn't put anything in beginning retained earnings. But so since we did have that there, we start with that. Then we're going to add in the net income, and the net income comes from the income statement. And then we subtract out our dividends. So our dividends we found, which is right here. So it gave us the dividends. If it didn't give you dividends, you would just subtract out nothing. And then that's your ending retained earnings. Now for your balance sheet, also, first, before I start with the balance sheet, make sure you take a look at the dates here. So your income statement and your statement of retained earnings are always going to be for the month ended. And then your balance sheet is going to be at the specific day. So for our balance sheet, we start with assets and we do cash is what we're starting with. We just take that amount from up here. Accounts receivable is also an asset, prepaid insurance, equipment, all assets. So we put all of those in first. And those are right there. Also, we do have to subtract out accumulated depreciation because depreciation expense would be considered an asset, but even though technically it would be, depreciation expense went right here, but since there was a accumulated depreciation amount right here, even though it's in a credit and you would think that an asset would be in the debit side, because of the specific account itself, we have to subtract that out. So we're going to subtract that out right there, and that's going to be the total assets. And then for liabilities, we take the accounts payable amount right here. So these are going to be all your liabilities right here, accounts payable and notes payable. Those are going to be two that you put right there. That's going to be your total liabilities. And then for stockholders' equity, the two amounts that we always put for stockholders' equity is always common stock and retained earnings. So then that's why those go there. But the retained earnings, we do not take from this amount. See, this amount is 54,400. But because we did the statement of retained earnings and found this ending balance right here, that's what's going to go right here. And then we find the total stockholders' equity, which is adding these two up, and then the total liabilities and stockholders' equity. So then the total assets always have to equal the total liabilities of stockholders' equity. And then for the closing journal entries, so essentially when doing a closing journal entry, you're basically just flipping your accounts out. So like I said, for this one, so sales revenue, that amount is directly, or sorry, service revenue is, it's directly from this and it's directly from the trial balance. So we take that and put that here. And since we're a closing journal entry, I'll put the definition first. So you're resetting temporary accounts to 0 on the ledger. They have to be closed. They have to be closed to a permanent account. So that's why we're using retained earnings. So this sales revenue, we're taking this amount right here, which was from up above. And then we're going to credit the retained earnings account because like I said, you have to put it to a permanent account. Retained earnings is very similar to income. It's kind of like just a holding account. So that's why you can just credit it to that account. And then since we're dealing with expenses now, normally expenses go in the debits, but since we're flipping them and closing them out, they're going to be in the credits. And then we can just debit retained earnings to close it out. And then dividends, since it's not considered a revenue or expense, it has to go by itself. So since it would normally be debited, we're going to credit it, and then we're going to debit the retained earnings. So that is the 2019 exam. Now I will go over the 2020 exam. So this is the 2020 exam. This was last year's. It's going to be most similar to the exam. Like I said, it's definitely not going to be exactly the same, but it will be the most similar one. So first, the owner of the business are not taxed on profits of the business if the business is a, let me see first, don't know why it's not letting me. One second, let me see why. Enable saving real quick. Okay, perfect. Sorry about that. So the owner of the business are not taxed on the profits of the business if they are a corporation. And the reason for this one is because it deals with the owner. So they're going to be, a corporation is taxed with corporate taxes. They're not taxed on the specific owner themselves. Also on this practice exam as well, we have all of the answers back here as well, but we're just going to go through it. With respect to the audience targeted for financial accounting reports, which of the parties below is not an external user? So this is going to be B, managers of the company issuing the reports. So they are not an external user because they're working for the company. They're the manager of the company. So they can't be, they'd be an internal user. Next, accounting systems. The definition of an accounting system is to analyze, record, and summarize the effects of the financial condition and performance. So that's just definition based. Net income, we just went over this. It's going to be revenues minus expenses. So that's just also a definition. That's going to be B. Operating activities, investing activities, and financing activities are all going to be on A, the statement of cash flows. That's also just another definition we went over in the other exam. If a company borrows money from a bank and signs an agreement to repay the loan several years from now, which account would the company report borrowed? So since it says in this question, you're repaying a loan and you sign an agreement, when you borrow money from a bank and sign an agreement, it's always going to be notes payable. And it's going to be long-term because it says several years. Okay, and now equity financing is financing obtained from. So this is also very similar to what we did. We said for stockholders' equity in the other exam. So that's why it's going to be stockholders. Which of the following is an accounting transaction? So this one is going to be a manager signing a promissory note and receiving cash. This would be a journal entry, so that's why it's going to be an accounting equation. Hiring an employee, that's just an employee gets hired. It's not, doesn't have anything to do with like any transaction until the employee gets paid. And when you agree to deliver their product in 3 weeks, it doesn't say anything about like anything with being paid or receiving money or anything like that. Same with ordering supplies. So it doesn't give you two options. That's why it's only that one. Which of the following is an asset? This one is going to be notes receivable, and retained earnings is stockholders' equity. Stockholders' equity for that one. Notes payable is a liability. Common stock is stockholders' equity. Transactions are entered into a blank each day they occur. So that's going to be a journal. That's also just definition. They always have to go into a journal first, and the journal is going to be kept daily. Every transaction has at least two effects on the basic accounting equation. So basically, a transaction has to do one thing to balance out the other. So that's why it's always going to have two effects. It could have more than two, just like we did in that other journal entry where it had equipment, cash, and accounts pay or notes payable, because it could have more than one to balance it out, but it has to have at least two to balance. Which of the following is an operating activity? So an operating is a normal course of business. So it would just be billing customers for services rendered. Which of the following items appear on an income statement? That's going to be revenues. So like we said, with revenues, it's revenues minus expenses. That gives you your net income. Income tax expense appears on the blank, while income tax payable is a blank. So income tax expense, since it's an expense, it's going to appear on the income statement, while a payable account appears on the balance sheet. Since it's a payable, it's a liability. Reporting revenues when they're earned and expenses when they are occurred is called accrual. So we just went over these two different definitions. So if you look back into the other one, it will give you the definition for cash basis as well. When cash is received in advance of a performance obligation being satisfied, a blank called blank is recorded. So this is going to be a liability and deferred revenue. So if it's in advance, that means it would be deferred revenue. So that's the key word. And for a performance obligation, so it's going to be a liability and deferred revenue. Adjustments to expense accounts at the end of accounting period are made to adhere to accrual accounting principles, specifically the expense recognition and matching. So since it gives you the keyword expense accounts, it would be expense recognition. They match expense match to accrual as well. All right, so our problems. So following is a list of financial statement amounts for Vantage Service for the first year in operation. So we're going to prepare an income statement. So that's revenues minus expenses. So we're going to start with just revenues, put it here. And then we look up above, look at what our revenues are. This is going to be right here, sales revenue. That's the only revenue that it shows. So we just do one. If it showed more than one, we'd have to put them both down. So then we just put total, that amount right there. Then we go to our expenses. These anything that says the word expense. So that's this, and this. So we got fuel for $10.50. Normally you would put fuel expense, but I'm just gonna abbreviate the rest of them to go faster. So rent, 10,400, and normally we would do rent expense, like you'd have to put the expense there as well. Advertising, 50, salaries and wages. Oh my goodness. And that is 2,500. So then you would total it up, which is 4,600. And then your net income, which is revenues minus expenses, 56,500. It would be considered a net loss if expenses are greater than revenues. Next, we're going to do the statement of retained earnings. So for this one, we start with retained earnings. They don't give us any amount for retained earnings here. So that means there's no beginning amount. So we just leave that blank. And then we add in our net income, which is 56,500, which we just found from above on our income statement. If it was a net loss, we would subtract it out. And then we have to subtract out the dividends. And the dividends they give us right here, 16,800. So we'll subtract that out. And then we get retained earnings of 39,700. All right, so next is our balance sheet. We'll start with assets. So first, let's go up. So our assets are going to be cash, accounts receivable, and then let's see, what is our last? Equipment is going to be our last one. So first, it's going to start with cash, which is 1050. And then accounts receivable. Oh. Which is going to be 4,500. And then equipment, which is 5,250. So that's going to be total 100, 800. And then we're going to move to our liabilities. So our liabilities here is going to be accounts payable and notes payable are going to be our two liabilities. So AP. And that amount is 3,500. And then note payable is 10,100. And we total them up, which gives us 4,600. Oh. And then we move to stockholders' equity. Common stock and retained earnings. Like I said, those are always the stockholders' equity accounts. Common stock we find from above here, 2,500. And then for the retained earnings amount, we don't look up above in this question. We look at the statement of retained earnings that we just found. So that's 39,700. Then total stockholders' equity is going to be $6,200. And then total liabilities and stockholders' equity is $100,800. So this amount right here, the total liabilities always have to equal the total assets. The total liabilities and stockholders' equity combined always have to equal the assets. So next question, Arthur's Industries entered in the following transactions during the month of June. So essentially we're just going to do these journal entries. So purchase supplies for cash. So first you would put 1 here, and you would put A. So you purchase supplies, so that's what you're receiving. So you would debit supplies for $5,100, and you would credit cash because you paid for cash, or you paid in cash. And then next one, 2B, paid $45.80 for salaries and wages for the month of June. So that's going to be an expense on our end. So that's going to be salaries and wages expense of $45.80. And then you pay your employees in cash. So it's going to be cash. Like you can't pay them on account. They will pay you in a few years. You have to pay them in some form of actual physical items. All right, 3C. Let's move it down. Paid $460 in advance for July rent. So you paid rent in advance, it's going to be prepaid rent. What you're getting. And since you're paying it out, you're going to credit cash because like I said before, you pay rent in cash. It's very similar to paying employees. You can't tell your landlord, oh yeah, I'll pay you in like on account in like 60 days. Like that'll be marked late and then you'll get a late fee. Provided $13,600 in services on account. So for this amount, we're gonna debit accounts receivable because it says we provided them on account. So that's how you determine that. And then since we're using, it mentions services, we're gonna credit service revenue. All right, and then 5E. Paid $1,300 on accounts payable. So since we paid them out, we would, and since it says on account, we would have to debit accounts payable for the $1,300. And then when we paid them, cash is going out, we're crediting cash. That's all done. So the unadjusted trial balance of sketch star markers prepared December 31st, 2018. And the following account balances are all there. So this is very similar. So we are going to do more journal entries. So account of supplies revealed $1,800 worth on hand. Very similar. You start with 1A. So so it says we're dealing with supplies. So it's going to be first an expense on our end. It doesn't say anything about cash, so we use supplies expense. And since we originally had $3,800 here, but we have $1,800 on hand, we subtract those out and you get $2,000. 2B. Oh, sorry, I forgot to. And we would credit supplies. Sorry. An insurance policy purchased on January 18th covers 4 years. So it's an expense on our end. Let me just move this down so it's easier to see. So we would debit insurance expense since we're talking about an insurance policy. And then we would credit prepaid insurance because it says that they paid it out for 4 years in advance. So for this prepaid insurance we look at is $7,600 right here. But since it says paid for 4 years and we're just looking for this 1 year, we would divide 7,800 or 7,600 divided by 4, which gives you 1,900. Okay, and then for 3, the equipment depreciates at $2,400 per year. No depreciation has been recorded yet as of December 2018. So for the standard depreciation journal entry, is 99% of the time going to be depreciation expense as a debit, and then accumulated depreciation as the credit. That's just going to be standard across the board for this class until you go into, if it gives you a specific accounts to use. So for this, so since it's recorded at 2,400 per year, we can just use that amount. Then for 4, 1/2 or 50% of the amount recorded as deferred revenue remains deferred. So for this one, since it gives you deferred revenue, that what we're using is we're going to debit deferred revenue. And we're going to credit service revenue. And we do this because it gives deferred revenue right here. And we credit the service revenue because when deferred, it means an item is not paid yet and they're performing a service. So that's why you'd have to use service revenue. So since it says 1/2, we would just take the 12,000 of deferred revenue and divide it by 2. That gives you 6,000. And then lastly, the accrued amount of salaries and wages is 3,400. So this one, it would just be salaries and wages expense, and then salaries and wages payable. And that's going to be just given amount 3,400. So these are all the answers right here. But other than that, that should be good. And like I said, you guys can stop at my office hours anytime next week. It's 1 to 3 on Monday, Wednesday, 9 to 12, Tuesday, Thursday. You can email me if you need anything else. And then I'll see you at either the review session or if not, good luck on the exam.